What if I told you that trying to beat the stock market isn't just, like, difficult, but that it's a literal mathematical zero-sum game?
Yeah, a lot of people don't realize that.
Right. I mean, every single dollar you win by picking a winning stock is essentially a dollar stolen directly from another very smart, very well-funded person who is trying to do the exact same thing to you.
It's a sobering thought.
It really is. So today we are tearing up the floorboards of institutional wealth management. We're looking at the foundational architecture of how money is actually grown, managed, and protected at the highest levels. Welcome to this deep dive.
Got to be here.
If you're joining us, you are in for a serious shift in how you view your own money.
Because the reality is the day-to-day noise,
Yeah.
the talking heads screaming about what the market did yesterday or the hottest new tech stock, it's completely irrelevant to the actual mechanics of wealth building.
Totally irrelevant.
Right. The true architecture of a portfolio is built on a very cold, highly structured system of probabilities, risk containment, and frankly, just managing human psychology.
And the goal today is to take those mechanics, which usually live behind closed doors at like massive pension funds or elite endowments, and hand you the blueprint.
Exactly.
Because whether you are managing a sovereign wealth fund or you're just, staring at the investing app on your smartphone trying to figure out what to do with your retirement account, the physics of investing do not change.
Gravity is gravity.
Gravity is gravity. Okay, let's unpack this. Before a professional investor ever buys a single stock or bonds or real estate, they don't just open a brokerage account and start clicking buy.
No, absolutely not.
They do something that feels almost overly bureaucratic. They sit down and write a hyper-specific, highly legally binding rule book.
Right. It is the absolute first step. In institutional finance, it's called the Investment Policy Statement, or the IPS.
The IPS.
Yeah, think of it as the foundational constitution of the portfolio. It's a collaborative, negotiated document between the person managing the money and the person who actually owns the money. You can't build a structure without knowing the exact dimensions of the land you're building on, right? Or the weather it needs to withstand, and what the building will actually be used for.
It's like a prenup with your own money.
That's a great way to put it.
You're setting the rules of engagement when everyone is calm so you don't do something crazy when things get emotional.
Yeah.
And inside this IPS, you have to define your objectives.
The big ones, obviously, being risk and return.
Right. But what struck me from the source text is how professionals define return. I think the average person just says, I want to make a lot of money.
Yeah, make number go up.
Exactly. But the institutional world splits this into an absolute return objective versus a relative return objective.
And it is a critical distinction because it fundamentally changes how you measure success. If you have an absolute return objective, you're picking a hard, unmoving number.
Like a specific percentage.
Right. You might say, based on my actuarial tables, I need to generate an annualized return of 7.5% to meet my pension obligations. So the market could be up 20%, or it could be down 15%. Your goal remains a rigid 7.5%. You're fighting against a fixed hurdle.
But a relative return objective is totally different. It's tying your success to a benchmark, like an index.
Yes.
For example, your goal might be to outperform the FTSE 100 index by 1.2%, or what professionals call 100 to money basis points.
Exactly right.
And this leads to a scenario that I think would blow the mind of a retail investor. If the entire FTSE 100 drops by 10% in a terrible year, but your portfolio only drops by 8.8%, you have succeeded.
You have met your objective perfectly.
Wait, you lost 8.8% of your net worth, you lost millions of dollars, but you popped the champagne because you lost slightly less than everyone else.
It sounds absurd to the layman, sure, but in the context of capital markets, it is a triumph. You preserved capital relative to the macroeconomic environment.
Wow. Okay, but an IPS doesn't just outline what you are trying to achieve. It rigorously defines what is holding you back, your constraints.
Right. Every investor, from a billionaire to someone with a basic savings account, operates inside a cage of constraints.
Let's walk through those bars of the cage. First, you have liquidity.
Yes, very important.
That's simply how much cash you are going to need to yank out of the portfolio in the near future. Like, if you need to pay for a wedding next year, you can't have all your money locked up in a 10-year private equity fund.
Exactly. You need that cash available.
Second is time horizon. Are we investing for a toddler's college fund, or are we investing for an 85-year-old's end-of-life care? The physics of time completely change the risk you can handle.
Then you have your tax status.
Oh, yeah.
A tax-exempt charity is going to construct its portfolio in a radically different way than, say, a high-net-worth individual living in a jurisdiction with aggressive capital gains taxes.
Makes a huge difference.
Following that are legal and regulatory constraints. A life insurance company, by law, might be completely prohibited from holding certain highly speculative assets.
They just literally can't buy them.
Right. And finally, you have unique needs, which is just the catch-all for anything highly idiosyncratic to the client.
So you map out the goals, you map out the constraints, but the most fascinating part of this entire blueprint phase where high-level math suddenly crashes headfirst into human psychology is how risk is evaluated.
It's incredibly complex.
It's not just a checkbox. The evaluation of risk is split into two completely separate, frequently warring concepts: your ability to take risk and your willingness to take risk.
This is where financial engineering becomes human behavioral science. A client's true risk profile is a volatile mixture of these two factors.
Okay, break that down for me.
Well, ability is your objective financial reality.
Yeah.
It is a math equation. We look at your stable income, we look at your time horizon, we look at the size of your wealth relative to your liabilities.
So just the raw numbers.
Exactly. And the math tells us exactly how massive of a market crash you could survive without missing a meal or defaulting on a debt. It's cold and factual.
Right, it's your financial metabolism. It's what your body can physically process.
That is an excellent way to conceptualize it. Willingness, on the other hand, is purely subjective. It's your appetite.
Your emotional tolerance.
Yes, your psychological tolerance for watching your net worth evaporate on a screen. How much volatility can you stomach before you pick up the phone in a panic and demand that we sell everything at the exact bottom of the market?
And to really understand how these two things clash, we should look at 3 specific profiles from the source material that illustrate this tension perfectly.
Let's do it.
Let's start with someone whose math and emotions are completely at odds. We have a 34-year-old widow. She has 2 young kids, 5 and 7 years old.
Yep.
She has been an administrative assistant at a very stable government agency for over a decade. Her goals are simple: fund her own retirement in 30 years and pay for the kids' college in over a decade.
So let us calculate her objective ability. Her time horizons are incredibly long. 30 years for retirement is an eternity in market cycles.
Yeah, plenty of time to recover from a crash.
Exactly. She has a highly stable, predictable income from a government entity, meaning the likelihood that she will suddenly need to liquidate her long-term investments just to buy groceries is very low.
Right.
Therefore, strictly by the numbers, her ability to take risk is exceptionally high. Her portfolio could drop 40% tomorrow, and her daily life would not change in the slightest. The math says she should be heavily invested in volatile, high-growth assets.
But imagine sitting across the desk from her. She's a single mother. She is the sole provider for 2 young children. Her psychological willingness to take risk is probably practically non-existent.
Almost certainly.
She views that money as her children's literal survival. If you put her in a high-growth, high-volatility portfolio, the first time the market dips 10%, she will lose sleep, panic, and demand you move everything to cash.
Right, her appetite is incredibly low, even though her metabolism is high.
Exactly.
Now contrast her with a completely different psychological profile.
Yeah.
Imagine a man whose income is derived entirely from something unpredictable. Let's say his earnings swing wildly between 30,000 and 70,000 pounds a year.
Wow, that's a huge swing.
It is, and it's entirely dependent on weather patterns affecting his industry.
That is a terrifying way to make a living.
It's extremely precarious. In fact, let's say in 3 of the last 5 years, his after-tax income was less than 20,000 pounds. Meanwhile, his fixed living expenses are 12,000 pounds, and he provides 9,000 pounds a year to support his elderly mother.
Wait, so in a bad weather year, his fixed expenses are 21,000 pounds, but he only brings in 20,000. He is literally bleeding cash just to survive.
Yes. His liquidity needs are high, his income is volatile, and his fixed liabilities are rigid. His objective ability to take financial risk in the markets is near zero.
Right.
If his portfolio crashes during a bad weather year, he cannot feed his mother. He faces total ruin. What if his psychological profile is the exact opposite?
Right. Let's say this guy spends his evenings actively day trading commodity futures, buying speculative options, and shorting volatile tech stocks.
Oh, boy.
He loves the adrenaline. He takes those psychometric risk questionnaires and scores off the charts. He views himself as a financial cowboy.
You have a catastrophic misalignment. His subjective willingness is sky high, but his objective ability is rock bottom. He wants to eat the most dangerous, spicy financial diet imaginable, but his actual metabolic reality means a single bad meal will kill him.
So how does a professional handle that? If this cowboy comes into your office, demands you put all his money into leveraged cryptocurrency or volatile commodities, and you say, actually, sir, based on your income, I am only allowing you to buy ultra-safe, boring government bonds, he's going to stand up and fire you on the spot.
Very likely, yes.
How do you resolve that tension without alienating them?
It requires intense behavioral coaching, but fundamentally, a fiduciary, someone legally bound to act in the client's best interest, must always anchor the portfolio to the lowest metric.
You have to protect them from themselves.
Exactly. If the ability to take risk is low, you cannot, in good conscience or under legal scrutiny, build a high-risk portfolio, regardless of the client's demands. The objective math of potential ruin must overrule the subjective desire for thrills.
Wow.
The manager has to use the IPS as a mirror, reflecting the client's reality back to them, showing them exactly how a 20% market drop in a bad weather year destroys their mother's care fund.
The blueprint removes the ego from the room. It forces you to look at the math. And there's a third scenario, which is probably the most common one we see with very successful people.
High earner.
Yeah, a high-earning professional making over 120,000 euros a year. Her job is bulletproof. She has no dependents, no debt, and her living expenses are only 45,000 a year. She is generating massive amounts of surplus cash every single month.
Her objective ability to take risk is arguably higher than anyone we have discussed. She is impervious to standard financial shocks.
But she is absolutely terrified of the stock market. She keeps every single euro in short-term, low-yield, government-guaranteed bank accounts. The idea of losing a single cent gives her anxiety. Her willingness is zero.
In this scenario, where ability is high but willingness is low, the manager faces a different challenge. You're not protecting the client from ruin, you're protecting them from inflation and opportunity cost.
Because inflation will just eat that cash.
Exactly.
Yeah.
If she leaves millions in cash for 30 years, her purchasing power will be silently decimated. The manager's job here is gentle education. You slowly introduce risk, perhaps starting with high-quality corporate bonds, gradually moving to conservative dividend-paying equities, expanding her comfort zone incrementally while always respecting your boundaries.
So after this intense psychological and mathematical negotiation, the IPS is finalized. You have your goals, your constraints, and a clear-eyed assessment of your risk tolerance. Now, you have to actually build the portfolio. You have to decide what assets you are going to buy.
Which brings us to the most consequential structural decision an investor will ever make: establishing the strategic asset allocation.
Strategic asset allocation, or the SAA, this is the permanent foundation. This is where you decide the big picture weights, like, am I going to be 60% in the stock market and 40% in the bond market? Or 80% stocks and 20% real estate?
Precisely.
And what's crucial to understand is why we set these permanent weights. It's based on something called systematic risk.
Yes, systematic risk is the gravitational pull of the entire market. It's the macroeconomic risk that you simply cannot diversify away.
You can't hide from it.
No, you really can't. If a global pandemic hits, or central banks hike interest rates to 10%, it doesn't matter how brilliant your individual stock picks are. The entire equity market is going to suffer.
Right.
When you set your strategic asset allocation, you are deciding precisely how much of that unavoidable market gravity you want to expose yourself to over the next several decades.
You are picking your weather system. If you choose 90% equities, you are choosing to live in a place with intense, beautiful summers but terrifying, destructive hurricanes.
That's a great analogy.
And if you choose 90% bonds, you're choosing a place where it's always just a mild, cloudy 60 degrees.
That is an apt way to describe it. And academic research has proven, unequivocally, that your strategic asset allocation dictates the vast majority of your long-term returns. It's not the individual stocks you pick, it's the macro-level asset classes you choose to hold.
But to build a good foundation, you don't just pick one asset class, you combine them. And you combine them based on their statistical relationship to one another, which is called pairwise correlation. Let's break this down, because this is the actual magic trick of diversification.
Correlation measures how two different assets move in relation to one another on a scale from -1 to +1. If two assets have a correlation of exactly 1.0, they move in perfect identical lockstep. If one goes up 5%, the other goes up 5%. If you buy two assets with a 1.0 correlation, you haven't diversified anything. You just bought two copies of the same risk.
So you want to find asset classes that have lower correlations to each other. When one zigs, you want the other to zag, or at least just stand still. And looking at global equity markets from the text, the data is really revealing.
It really is.
For instance, the correlation between the US stock market and the European stock market is 0.90. That is incredibly high.
It is. Their economies are deeply intertwined, their banking systems are connected, and major multinational corporations operate across both regions.
Right.
A shock to the U.S. system almost instantly reverberates through Europe. So, buying European equities alongside U.S. equities provides some diversification, but not a massive amount.
Similarly, the US market, compared to East Asian equities, has a correlation of 0.88, still moving together most of the time. But then you look at a market like Brazil, the correlation between US equities and Brazilian equities drops down to 0.76.
Exactly. Because the Brazilian economy has different drivers, perhaps more heavily weighted towards specific commodities, with different domestic political cycles, and a less tightly coupled banking system, it operates with a greater degree of separation from the U.S. market.
Makes sense.
Because 0.76 is significantly lower than 0.90, combining U.S. equities with Brazilian equities provides a much stronger smoothing effect on your portfolio's volatility. Asset classes should have high correlations within themselves, but lower correlations against other asset classes.
It's like putting shock absorbers on a car. If the US market hits a massive pothole, the Brazilian market might still hit a bump, but the suspension absorbs a lot of the impact, keeping your overall portfolio from bottoming out.
That's the goal.
You combine all these different asset classes with different correlations to build a resilient strategic asset allocation. But there is a temptation to mess with it, and that introduces the concept of tactical asset allocation, or TAA.
Tactical asset allocation is the deliberate, active decision to temporarily deviate from your found SAA policy weights based on short-term market forecasts.
Let me give an example. Let's say my incredibly well-researched, deeply mathematical strategic asset allocation dictates I should hold exactly 60% of my wealth in U.S. stocks.
Okay.
But I turn on the financial news, I see some geopolitical crisis, and I suddenly get a gut feeling that the U.S. market is going to crash next month. So I sell some stocks, dropping my weight to 50%, and I move that 10% into cash to hide out. I'm making a tactical move.
And in doing so, you are introducing a completely new, uncompensated layer of risk into your portfolio. You are engaging in market timing.
Which feels like a terrible idea. If the strategic asset allocation accounts for most of the long-term gains, why do we even bother with tactical asset allocation? Isn't TAA just fancy market timing?
Essentially, yes.
It feels like we spent months meticulously programming a GPS to take us across the country on the safest, most efficient highways, and halfway there, the driver just violently yanks the steering wheel to take a dirt road because he thinks he knows a shortcut. 9 times out of 10, you end up stuck in a ditch.
Many leading academics and quantitative analysts would completely agree with your assessment. The data consistently shows that market timing is extraordinarily difficult, if not impossible, to execute consistently.
Then why do professionals do it?
Well, active managers justify TAA by arguing that markets occasionally experience extreme, irrational dislocations, bubbles, or crashes that present obvious short-term opportunities. They believe their specific forecasting models are sophisticated enough to spot a traffic jam on the highway before the GPS does. But you are entirely correct that it is a gamble. Every time you deviate from your SAA, you are taking a risk that your forecast is wrong.
Okay, so let's say you decide to be disciplined. You set your strategic asset allocation. You decide you want 40% in U.S. large cap stocks. Now you face the next major fork in the road. How do you actually acquire that 40%?
The implementation phase.
Right. Do you go out and hire a brilliant, highly paid stock picker to analyze every single company and buy only the absolute best ones? Or do you just buy a completely blind, brainless index fund that owns every single stock of the market automatically?
You're describing the choice between active management and passive management. In institutional terms, this decision is referred to as allocating your risk budget. You must decide, asset class by asset class, whether attempting to actively select individual securities is worth the inherent risk and cost.
And here is where we get to the core revelation, the absolute zero-sum reality of the market. Let's break down the mechanics of a single trade, because once you see this, you can't unsee it.
It's the inescapable mathematics of secondary financial markets. When you invest passively buying an index fund, you are simply participating in the overall growth of the economy. You are earning the systematic return.
Right.
But active management security selection is entirely different. You are attempting to generate a return that is higher than the benchmark index.
Let's say the benchmark index is the S&P 500. It holds 500 companies. If I'm an active manager and my research tells me that Apple is going to have a phenomenal year, I want to hold more Apple than the index does. I want to overweight it.
Yes. But to buy more Apple, you need cash. Where does that cash come from?
From selling something else.
Exactly. You must simultaneously underweight or sell another company in the index that you believe will perform poorly. You're making a definitive claim. Apple is mispriced too low, and this other company is mispriced too high.
But I'm not buying those Apple shares from a machine. I am buying them from a human being. Every transaction requires a buyer and a seller. So if I'm aggressively buying Apple because I'm a genius who thinks it's going up, the person selling it to me must think it's going down. One of us is objectively wrong.
Exactly. You're in direct competition. Now, zoom out and look at the entire market. All the shares of Apple, all the shares of IBM, they're all owned by someone. If you aggregate the performance of every single active investor in the market, what does it equal?
It equals the market itself.
Precisely. Before we factor in any costs, the mathematical average of all active investors will perfectly match the return of the passive index. For every active manager who beats the benchmark by 2%, there is another active manager who lost to the benchmark by exactly 2%. The gross return is a perfect zero-sum game.
But it's actually worse than a zero-sum game, isn't it? Because playing the game costs money. If I'm an active manager, I have to hire armies of Ivy League analysts. I have to pay for Bloomberg terminals. I have to pay trading commissions every time I buy and sell.
Yes, the transaction costs and management fees for active management are significantly higher than passive management. Therefore, if the gross return of all active managers equals the market, the net return of the average active manager, after you subtract all their expensive fees, must mathematically underperform the passive index.
That is devastating. If it is mathematically guaranteed that the average active manager will lose to a brainless index fund after fees, why is active management still such a massive industry? Are people just overconfident?
Ego and the allure of the exception. The fact that the average manager underperforms does not mean that zero managers outperform. The entire wealth management industry is built on the belief that it is possible to identify the elite minority of managers who genuinely possess superior skill.
But the odds are against them.
Yes, but beyond skill, there is a structural factor that determines whether active management even has a chance of succeeding. It comes down to something called informational efficiency.
Okay, I love this concept. Let's unpack informational efficiency.
An efficient market is a market where the current price of an asset almost instantly and perfectly reflects all available public information about that asset.
Okay.
For a market to achieve high efficiency, it requires several components: a massive number of investors, a highly liquid trading environment, and near instantaneous dissemination of news and data to all participants simultaneously.
So, U.S. large-cap stocks, the massive trillion-dollar companies, Apple, Google, Amazon. Let's visualize what happens when Apple releases its quarterly earnings report.
The moment that report hits the wire, it is not being read by a human. It's being ingested by thousands of algorithmic trading supercomputers co-located in server farms right next to the stock exchange.
Wow.
These algorithms parse the data, run complex valuation models, and execute trades in fractions of a millisecond. Furthermore, tens of thousands of highly incentivized human analysts are scrutinizing every syllable the CEO utters on the earnings call.
So if Apple announces they sold 10 million more iPhones than expected, the stock price adjusts upward before a normal retail investor can even open their laptop. All the good news is instantly baked into the price.
Exactly. Because the market is hyper-efficient, there are virtually no hidden gems. There are no obvious mispricings for an active manager to exploit. Trying to consistently find an edge in U.S. large-cap stocks is an incredibly brutal endeavor.
Let's use an analogy. Trading U.S. large-cap stocks is like sitting down at a poker table where every single opponent is a world champion mathematician, everyone is wearing mirrored sunglasses, and they all have high-definition cameras pointed at your face reading your micro-expressions.
That paints a picture.
Right. Your odds of outsmarting them and taking their money are virtually zero. You are the sucker at the table.
A very accurate visualization. But not all markets are the World Series of poker.
Right. What about a completely different market? Let's say emerging market corporate bonds or obscure regional equities in a developing nation.
Now you are entering an inefficient market. These markets may lack the sophisticated technological infrastructure. Information does not flow instantaneously. Corporate disclosures might be opaque, regulatory oversight might be inconsistent, and there are far fewer analysts dedicating their lives to studying these specific assets.
So to keep the poker analogy, treating obscure regional bonds is like walking into a dimly lit backroom casino and playing cards against a bunch of tourists who don't know the rules. If you actually know how to play, if you do your research, you have a massive advantage. You can exploit their lack of information.
Precisely. In an inefficient market, a skilled active manager actually has the runway to generate excess returns. Their deep research uncovers realities about a company that the broader market simply hasn't realized yet. And there is one area where active management isn't just an option, it's mandatory.
Illiquid alternative assets, things you physically cannot buy in a passive index.
Exactly. Consider direct investments in non-listed commercial real estate or private infrastructure projects like a toll road or renewable energy facility.
You can't just buy an ETF for that.
No, there is no passive ETF that perfectly captures the global toll road market. These assets are highly unique, fiercely negotiated, and incredibly difficult to price. If you want exposure to these asset classes, you have absolutely no choice but to engage in rigorous, active, deal-by-deal security selection.
Okay, so let's summarize where we are. We've survived the psychological gauntlet of the eye test. We've set our permanent strategic asset allocation weights. We've recognized the brutal zero-sum math of active trading. So for our highly efficient equity markets, we just bought passive index funds. We have built the perfect unassailable portfolio. We can just close the laptop, go sit on a beach for 10 years, and let the math work right.
If only it were that simple. You're forgetting that the market is a living, breathing entity. The moment you finish building the portfolio, the foundation begins to shift. You're now facing the relentless reality of drift.
Drift, it sounds like such a gentle, harmless word, but it will completely destroy your portfolio from the inside out if you ignore it.
Drift is the mathematical consequence of different assets growing or shrinking at different rates over time. Imagine you build a portfolio that is perfectly split, 50% stocks, 50% bonds. You go to the beach. Over the next 5 years, the stock market goes on a historic, roaring bull run, doubling in value. Meanwhile, the bond market remains completely flat, generating almost nothing.
So when I come back from the beach and open my laptop, I don't have a 50-50 portfolio anymore. The stock portion has swelled massively, while the bond portion has shrunk in proportion. I might now be holding 80% stocks and 20% bonds.
Precisely. And remember our discussion about systematic risk. A portfolio that is 80% equities is radically more dangerous, vastly more volatile than a 50% equity portfolio. Without you making a single conscious decision, your portfolio has drifted far beyond the risk constraints you established in your investment policy statement.
You're suddenly driving a race car when you thought you were in a minivan. Here's where it gets really interesting. Doing nothing, letting it drift, actually changes your risk profile. You have to actively trade just to stay in the same place. Neglect is a strategy, and it's a bad one. So to combat drift, you have to implement a rebalancing policy.
A rebalancing policy is a strict, predetermined mechanical rulebook for exactly when and how you force the portfolio back to its original strategic asset allocation targets. The most common method is establishing a bandwidth or a corridor around your target weights.
Like saying, my target is 50% stocks, but I'll allow it to drift up to 55% or down to 45%. But the second it hits those borders, I take action.
Yes, that's exactly it.
And to truly understand the life or death importance of a strict rebalancing policy and the psychological agony of executing it, we have to look at the case study of the European charity from the source material. This is a masterclass in how human emotion destroys wealth.
It's a phenomenal, albeit painful, illustration of the concepts we've discussed. Let's set the stage. We have a European charitable endowment. They have a very clear board-approved investment policy statement. Their target strategic asset allocation is diversified. 30% European equities, 15% international equities, 20% government bonds, 20% corporate bonds, and 15% cash.
And their rebalancing corridor is extremely tight. It is a strict plus or minus 2% around each of those targets.
Correct. So for the European equity allocation, the target is 30%. The absolute minimum they are allowed to hold is 28%, and the absolute maximum upper limit is 32%. If the weight crosses those boundaries, the policy mandates they must trade to restore balance.
So the year begins, and the market absolutely explodes. Over the first 6 months, European equities go on a tear, returning a massive 15%. International equities jump 10%. The bond markets and cash are basically stagnant.
Right.
Because the European stocks grew so rapidly, they ate up a larger percentage of the pie. The portfolio experiences severe drift. The weight of European equities swells from the 30% target past the 32% limit, hitting 32.4% of the total portfolio.
They have officially breached their IPS constraints. Now, they're not unhappy. The total portfolio generated a very healthy 6.6% return over those 6 months. They are making money. But they are out of compliance. They have too much risk.
Now, what should they do? If they were emotionless robots following the rules, what is the mechanical move?
The mechanical discipline move is to sell the excess European equities, the asset that has just made them a fortune, bringing the weight all the way back down to the 30% target. They would take those profits and use them to buy bonds, the asset that has done nothing, bringing the bonds back up to their 20% target. You sell high and you buy low.
But that feels terrible. Human psychology hates selling the winning lottery ticket to buy a stagnant asset. And this is where the charity makes their fatal error. The investment committee convenes. They look at the roaring European stock market. They read the bullish economic reports. And they get greedy. They succumb to the temptation of tactical asset allocation.
Exactly. They form a subjective, short-term viewpoint. They convince themselves that the European equity rally is going to continue. So instead of resetting the portfolio back to the 30% baseline, they decide to ride the wave.
Wait, so they just left it at 32.4%?
Not exactly. They trimmed the European equities back to 32%, parking it right on the absolute razor's edge of their maximum allowed limit. And instead of buying the underperforming bonds to restore their weight, they just leave the proceeds in cash. They intentionally choose to remain overexposed to the stock market.
They yanked the steering wheel to take the dirt road because they thought it was faster. And over the next 6 months, the market violently punishes them. The environment shifts. European equities completely reverse course, plunging -9%. International equities drop -6%. And the boring bonds, which they stubbornly refuse to buy, suddenly rally, returning +4%.
The fallout is severe. Because they were intentionally overweighted in the asset that crashed and underweighted in the asset that rallied, the total portfolio loses 2.84% in the second half of the year.
But the true brilliance of this case study is that it doesn't just say they lost money. It isolates the exact mathematical penalty of their arrogance. It calculates what their return would have been if they had just followed the mechanical rebalancing rule back to 30% versus what they actually earned by tactically hovering at 32%.
The attribution analysis is unforgiving. That specific, deliberate decision to tactically deviate from their policy weights cost the charity exactly -0.3 user% in return contribution. That wasn't just market volatility. That was a self-inflicted wound caused entirely by human hubris and a failure to adhere to their own blueprint.
Is human emotion the biggest enemy of a rebalancing policy? It seems the charity failed because they fell in love with their winning asset. That -0.30% is the cost of ego. Rebalancing is so difficult because it demands that you act entirely counter to your deepest survival instincts.
It really is. The crowd is running toward the roaring fire, and rebalancing forces you to turn around, walk away from the warmth, and go stand in the cold. The charity projected recent past performance into the infinite future.
Which is the most common cognitive error in investing. And this profound vulnerability, the realization that human error, flawed forecasting, and indiscipline destroy so much wealth, is precisely why new technologies have started taking the wheel.
Yes. The text highlights two newer, interconnected, and somewhat less structured developments that are democratizing and automating portfolio management. The explosive growth of exchange-traded funds, or ETFs, and the rise of algorithmic portfolio management, commonly referred to as robo-advice.
Let's define these because they have completely changed how retail investors interact with the market. An ETF is essentially a basket of securities, like a mutual fund, but it trades on a stock exchange just like a single share of Apple. You can buy and sell it instantly during the day.
Fast, cheap, liquid exposure to asset class indices.
Right. They are overwhelmingly passive, designed to simply track an index, which means they don't have to pay massive teams of Ivy League analysts. Consequently, they are ridiculously cheap to own.
And robo-advisors are the intelligent delivery mechanism for those ETFs.
Oh.
A robo-advisor uses algorithms to drastically reduce the cost for retail investors to build well-diversified portfolios. It asks the user a series of questions to assess their ability and willingness to take risk. It formulates a strategic asset allocation, it constructs the portfolio using low-cost ETFs, and most importantly, it implements a relentless, emotionless, automatic rebalancing policy.
So when your app drifts past its target, the algorithm doesn't convene a committee meeting to debate if European stocks are going to keep going up. It just ruthlessly sells the winner and buys the loser in milliseconds.
Exactly. But the shift toward this technology isn't merely about lowering fees or saving time. It represents a fundamental, structural critique of traditional financial theory itself. The industry grew deeply frustrated with the flaws of traditional modern portfolio theory, or MPT.
Why? MPT sounds incredibly sophisticated. It's the whole idea of inputting all your data into a giant mathematical optimizer and it spits out the mathematically perfect portfolio. It sounds like science.
It is science, but it relies on an unstable foundation. The MPT optimizer is hypersensitive to the inputs you feed it. Small errors in return forecasts or estimated correlations can result in terrible portfolio construction.
Really? How sensitive is it?
Well, the entire model requires you to input your forecast for what an asset will return in the future. But as we established, human beings are terrible at forecasting. If your prediction for the return of emerging market equities is wrong by even 0.5%, the MPT optimizer might radically alter the entire structure of the portfolio, recommending massive, concentrated, dangerous positions.
It's like programming a rocket to go to Mars. If your initial angle is off by 0.001 degrees at launch, you don't just miss a little bit. You miss the entire planet and fly off into deep space.
A perfect analogy. Furthermore, the correlation data we discussed earlier, like the 0.76 between the US and Brazil, is historical. It is backward-looking. During periods of severe global financial crisis, those historical correlations often break down. Suddenly, everything correlates to 1.0 as all markets crash simultaneously. The optimizer assumes stability where there is actually chaos.
So the practitioners basically threw their hands up and said, we're terrible at guessing the future. We don't know what returns will be. We don't trust our own correlation forecasts. So how do we build a portfolio without pretending we can see the future?
Because practitioners recognize this instability, they shifted their entire philosophy. They moved toward models that do not rely on fragile return forecasts. Instead of weighting asset classes by how much money they hope they will make, they started weighting asset classes by their historical contribution to the total risk of the portfolio.
Okay, wait, explain that shift. How is weighting by risk different than weighting by return?
Let's say you have an equity allocation and a bond allocation. Instead of saying, I expect stocks to return 8% and bonds to return 4%, so I'll buy a 60-40 split, you acknowledge your ignorance. You say, I have no idea what they will return. But I know mathematically that equities are historically 3 times more volatile than bonds. Therefore, I will structure the weights so that the volatility contribution from equities perfectly balances the volatility contribution from bonds. You're engineering the portfolio based on risk equivalence, not return prediction.
It's an admission of humility. You stop chasing illusions of future profit, and you focus entirely on stabilizing the ship's center of gravity based on known physics. And the algorithms and cheap ETFs are the perfect delivery mechanism for this less forecast-dependent strategy.
Exactly.
But if algorithms and ETFs can perfectly balance risk without human forecasting errors, does this mean the traditional investment manager is becoming obsolete for the everyday investor?
For the vast majority of standard retail investors in the accumulation phase of wealth, it is becoming exceedingly difficult to justify the high fees of a traditional human manager for pure portfolio construction. The algorithms simply do the mechanical labor better.
So they are obsolete.
Not entirely. While algorithms are great at math, they struggle with human values. They only speak the language of numbers. They cannot comprehend human nuance, qualitative judgments, or deeply held personal values. Which leads us to the fastest growing area of portfolio construction.
Right. We're moving beyond just balancing financial risk. We're talking about investing with impact.
We are entering the realm of ESG, environmental, social, and governance considerations. And let us be clear about the scale of this phenomenon. This is not a fringe movement.
Yeah, the text notes that by the start of 2018, nearly 31 trillion US dollars in AUM was dedicated to this.
31 trillion. It has fundamentally rewired global capital allocation.
Trillions of dollars. And there are several different ways this is actually implemented in a portfolio. It's not just one blanket strategy. Break down the implementation methods for us.
The most basic version is negative screening. So this is exactly what it sounds like. You draw a line in the sand and say, I absolutely refuse to own any company that produces tobacco or manufactures cluster munitions or operates private prisons. The algorithm simply excludes bad actors.
You're intentionally starving those industries of your capital.
Conversely, you have positive screening. Instead of just filtering out the worst offenders, you actively hunt for the best-in-class companies. You mandate the portfolio to only include corporations that score in the top quartile of their industry for carbon reduction or diversity metrics or labor relations.
Then you have thematic investing, where you bias toward a specific theme you believe in, like a portfolio entirely dedicated to clean water technology or renewable energy infrastructure.
Right. And impact investing, which goes a step further. You aren't just buying a stock. You are selecting based on an intention to create positive change, like a microfinance initiative in a developing nation, with the explicit dual goal of earning a financial return and generating a measurable social good.
But perhaps the most aggressive tool in the ESG arsenal is shareholder engagement, also known as active ownership.
This is fascinating because it's the exact opposite of negative screening. Instead of selling a bad company stock to avoid them, you intentionally hold the stock so you can fight them from the inside.
Because when you own shares in a publicly traded corporation, you own a fraction of the company, which grants you voting rights.
Exactly. Institutional investors pool their massive holdings together to exert immense pressure on corporate boards. The text cites Climate Action 100 Plus as a prime example of collaborative initiatives.
Right. They engage with top corporate greenhouse gas emitters.
Yes, they target the world's largest corporate emitters, the massive oil companies, the heavy industrials, and they use their voting power to force these companies to implement climate transition plans. It's a transition from passive exclusion to aggressive systemic influence.
They walk into the boardroom and say, we own 15% of your company, and if you don't lower your emissions, we are going to vote to fire the CEO. It is raw financial power applied to environmental issues. But the holy grail of ESG, and what the source text spends the most time exploring, is ESG integration.
ESG integration is the process of adding ESG to traditional financial analysis, removing it from the separate qualitative morals bucket and forcing it directly into the hardcore quantitative financial analysis of a company's valuation.
And the text provides an incredibly detailed deep dive into the Mountain Materials case study to prove how this works in practice. It's a masterclass in how a social problem becomes a balance sheet problem.
Let's look at Mountain Materials. They are a massive cement manufacturer in South Africa.
And making cement is inherently dirty, energy-intensive, and hazardous.
Extremely. And the ESG risks are mounting. South Africa introduced a national carbon price between $5 and $15 per ton. Mountain lacks emission programs, they have toxic air issues, and their employee safety records are very poor.
So enter our analyst, Ved Disha. He's looking at Mountain Materials, trying to decide if he should buy their stock for his portfolio. First, he runs a traditional pre-ESG financial model. He recalculates the company's expected internal rate of return, or IRR.
For a layman, think of IRR like the interest rate on a savings account, but applied to the complex future cash flows of an entire massive corporation. A higher IRR means a more lucrative investment.
So in his traditional model, before ESG integration, what were the numbers?
Before ESG integration, the base case IRR was 15% with a 2% dividend. In the institutional world, an expected 15% IRR is an incredibly attractive asset. Based purely on that traditional model, Disha justifies giving Mountain Materials a substantial 1.5% position size in an overall portfolio. It looks like a massive winner.
But then Disha does his actual job. He runs the model again, but this time he quantitatively integrates the ESG risks. He translates the smoke coming out of their chimneys into dollars and cents.
And the financial illusion shatters. After ESG integration, things look very different. Disha analyzes the new carbon tax and calculates that the compliance equipment costs will erode their operating margins by 1%.
Ouch. Next, he looks at the fuel. They can't keep burning cheap, dirty coal under the new regulations. They have to switch to cleaner gas power,
which dampens margins by another 2%. So immediately they are moving backward. Furthermore, because Mountain is suddenly forced to spend heavily just to retrofit their plants, Disha concludes they can no longer afford to reward their investors. The dividend expectation drops to 0%.
But the final blow is the hardest to quantify. Disha looks at their terrible employee safety record.
Yes. The capital markets discount the multiple due to safety concerns. The market views them as toxic, both literally and financially.
Because investors demand a discount to hold such a risky asset.
Exactly. So let's aggregate the damage. The result is that the base case IRR drops drastically from 15% down to a miserable 5%. The dividend expectation drops to 0%.
Oh, wow.
And consequently, Disha cuts the portfolio position size from 1.5% to just 0.5%. He drastically reduces his exposure.
Now I have to play devil's advocate here. So what does this all mean? The text admits that limiting your investment universe might hurt returns, and academic research is mixed. Isn't ESG just a feel-good constraint that violates the goal of maximizing profit?
That's a common critique. However, proponents use the text to counter this perfectly. They argue that avoiding material risks, like the massive regulatory costs that hit mountain materials, and improving governance, actually protects and improves returns in the long run. ESG isn't just morals, it's risk management.
Vedisha didn't downgrade the stock because he is an environmentalist. He downgraded it because he saw a regulatory tidal wave about to crush their profit margin.
Exactly. By systematically analyzing environmental, social, and governance factors, you're identifying material financial risks before the rest of the market prices them in. You aren't sacrificing returns. You are protecting capital from unpriced hazards. Good governance and sustainable practices are indicators of a well-run, resilient corporation in the long term.
You are quantifying the previously unquantifiable. You are putting a hard dollar figure on a safety hazard or a carbon footprint. It's the ultimate evolution of the blueprint.
It is the integration of reality into the mathematics of portfolio construction.
This has been an absolutely incredible journey through the true mechanics of wealth management. We've synthesized a massive amount today. We've moved from the initial psychological profiling of the IPS, wrestling with the tension between ability and willingness to take risk. We went through the math of strategic weights and the zero-sum game of active trading.
We survived the drift of the European charity.
Right, and arrived at the modern frontier of algorithms and ESG risk integration.
And I want to explicitly tie this back to the listener, to you. Whether you are managing millions or just setting up a basic retirement account, these principles apply. You must know your true willingness versus ability to take risk. You need a strict rebalancing rule to prevent emotional mistakes, and you have to decide if you want to actively fight the market or passively ride it.
It's all about the foundation.
Yes, and that leads me to leave you with a final, provocative thought to ponder based on the source material. We established mathematically that security selection is a zero-sum game that relies on active investors to make the market efficient.
Right, the army of highly incentivized analysts.
Exactly. So what happens if the ETF and robo-advisor revolution completely takes over? If everyone becomes a passive index investor who is left to do the research and set the actual prices of the stocks?
Oh, wow. If nobody is reading the earnings reports.
The pursuit of perfect passive efficiency might eventually break the very market efficiency it relies on. The blueprint relies on a foundation of active traders that the blueprint itself is slowly destroying.
It's the snake eating its own tail. So tonight, when you look at your own portfolio rules, ask yourself if you're structured to survive the math. Thank you so much for joining us on this deep dive.